The stock market has been plummeting, and talk of a recession in the mainstream media hasn't been this intense for a long time. Is a recession right around the corner, or are we panicking over nothing? In today's video, we're going to look at the latest economic data and see what's really going on. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis for the U.S. and regional housing markets. The housing market doesn't operate in a vacuum, and what happens in the broader economy can have big implications for real estate. And with all the talk of recession these last few days, it has become even more relevant. Uncertainty over President Trump's tariff policies have left Wall Street with much uncertainty, pushing traders and investors to send stocks lower. As of Tuesday, March 11th, the S&P 500 was down 9.3% from its all-time high on February 19th, putting it right on the edge of being in official correction territory. You can feel the uncertainty in the air just by browsing the latest financial headlines, and a 9.3% decline for the S&P 500 in less than a month can have a real effect on your investment portfolio or retirement account. Trump's tariff policies are just too erratic. First, he imposes or threatens tariffs, then he delays them, then they're back on again. It's really hard for businesses to make decisions when they don't know how much their inputs are going to cost or if there are going to be barriers in their export markets. It is all this uncertainty that is driving the declines in the stock market recently. But here's the real question. Is a recession on the immediate horizon because of all this, as many in the mainstream media are talking about? First, let's take a look at where things stand in the latest economic data. One of the broadest economic indicators we can look at is gross domestic product, or GDP. It is the sum of all the goods and services the country produces. As of the fourth quarter of 2024, real GDP growth was 2.4% on a seasonally adjusted annualized basis, and we haven't had a negative quarter of GDP growth since the first quarter of 2022. Looking just at GDP, we know the economy has been steadily growing for the last few years. But that was last year. What about right now? We are still in the first quarter of 2025, so we won't have an official GDP estimate until the end of April, but we can look at a tool used by the Federal Reserve Bank of Atlanta that tracks current economic data and makes a projection of GDP growth for the current quarter we're in. As of March 6th, the Atlanta Fed's GDP Now models projecting a negative 2.4% growth for the first quarter. Now, that should get your attention. The Atlanta Fed's model is projecting negative growth for the broadest measure of economic activity in the U.S. Now, I need to point out that this is not a forecast of the Atlanta Fed. Like I said before, it's a tool. It looks at all the current economic data for the quarter and projects what the quarterly GDP growth would look like based on how the monthly data is looking so far. But this should be a big warning sign for us. We haven't had a negative GDP growth since the first quarter of 2022. Let's take a look at why this Fed tool is projecting negative growth for the current quarter. A drop in consumer spending has played a big role. In January, real personal consumption expenditures were 0.5% lower than December. Now, that may not sound like much, but consumer spending makes up the lion's share of GDP. As of the fourth quarter, it was 69.2% of total GDP, more than 2/3. January consumer spending is just 1 month of the quarter. We need to see how the February and March data come in. But if overall first quarter spending were negative by even a small amount, it would put a lot of downward pressure on overall GDP growth because it makes up so much of the total. But other consumer data for February are not looking good right now either. The University of Michigan's Index of Consumer Sentiment was down 10% from January to February, citing fears that tariff-induced price increases are imminent. If the current trends in the stock market, consumer sentiment, and consumer spending continue, we could indeed see negative GDP growth for the first quarter when the government releases their estimate at the end of April. But is one negative quarter of GDP growth considered a recession? Technically, no, but it depends on what else is happening in the economy. The National Bureau of Economic Research is the organization that makes the official determination of whether or not we are in a recession. They define it as a significant decline in economic activity spread across the economy, lasting more than a few months, and it's normally visible in production, employment, real income, and other indicators. So while GDP is an important indicator, it's not the only one considered. Let's see how some of the other indicators are doing. The February jobs report showed 151,000 jobs created, which was an improvement over the 125,000 jobs created in January. Not spectacular job creation numbers, but not disastrous either. No recession here. How about real personal income? In January, it was 0.3% higher than in December. No negative growth, no recession here. How about production? The Federal Reserve's index for industrial production was 0.5% higher in January compared to December. Again, no negative growth, no recession here. The point here is that just because we're seeing some weakness in one economic indicator doesn't mean that we're in a recession or one is imminent. The stock market and consumer and business sentiment are not hard economic data, so we need to keep that in mind as we react to the news. With that being said, there is a lot of risk out there right now. With President Trump threatening tariffs, then removing the threat, then threatening again, it creates big uncertainty for consumers and businesses alike. What can end up happening, even if the tariffs never go into effect, is that consumers and businesses can pull back on actual spending just because they don't know what is coming down the road. If that goes on long enough, like for several months in a row, it could then have the real impact of a pullback in economic activity that shows up in all these economic indicators. The takeaway from all this is that, in my opinion, a recession is not imminent right now, but if the uncertainty on trade policy, chaos in the stock market, and declining consumer business sentiment continues over the next few months, we could very well be facing one. But what do you think? Is recession imminent and I've got it all wrong? Or is the recent panic in the stock market short-lived and we are going to enter into a new era of economic prosperity through President Trump's policies? Let me know in the comments section down below. If you want to stay up to date on where things stand in the economic data as it comes in, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video when it comes out. Let me do the research for you and keep you up to date on how close we are or are not to a recession. Thanks for stopping by. I'll see you in the next video.